In early August, President Joe Biden characterized the Chinese economy as a ticking time bomb, primarily due to the stalling of China's economic recovery from the pandemic earlier this year. Recent economic data from China has left investors disappointed, as they were anticipating a robust rebound in the world's second-largest economy following its reopening. In April, youth unemployment soared to a record high of over 20%. The World Bank recently revised its 2024 forecast for Chinese economic growth to 4.4%, down from the initial estimate of 4.8%. While this remains a respectable growth rate for an economy of China's magnitude, it marks the slowest rate since the 1960s. Following the release of China's lackluster growth data for the first half of the year, several Western media outlets are drawing parallels between China and Japan in the 1990s, a period known as Japan's lost decades. In this video, we will explore the possibility of China following a similar trajectory to Japan, where its economy stagnated and plunged into a prolonged recession. Before delving into the discussion, we invite you to subscribe to our channel for more insightful videos like this one. The Lost Decade in Japan, Unraveling the Events. Between 1991 and 2003, Japan experienced a meager annual GDP growth of only 1.14%, with the average real growth rate from 2000 to 2010 hovering around 1%, significantly lower than that of other industrialized nations. The year 2020 marked the initiation of a new global recession as governments implemented lockdowns in response to the pandemic. The period spanning from 1990 to the present is commonly referred to as Japan's lost decades, and the challenges persist for Japan. So, what led to Japan's economic stagnation and the absence of recovery? Once hailed as the poster child of 20th century economic growth, Japan had undergone a remarkable transformation from a predominantly agricultural nation in the 1960s to the world's second-largest economy by the 1980s. Japan had mastered the art of producing high-quality products at affordable prices, which found widespread popularity worldwide, a scenario mirroring China's current status. Sony Walkmans filled the streets, Japanese cars cruised town roads, and children tuned in to Japanese cartoons on domestically manufactured televisions. Concurrently, Japan's successful businesses fueled a thriving stock market, and real estate values soared. This is where the hegemony of the United States becomes evident. At that time, the Japanese economy was outpacing the growth of the US, and its domestic industries were commanding international exports, and the US wanted to stop that. In collaboration with its key allies, the US entered into the Plaza Accord in 1985 with the primary objective of bolstering the Japanese yen to render Japanese exports less competitive on the global stage. The central aim was to rectify trade imbalances, especially the substantial US trade deficit. By devaluing the dollar, the intention was to enhance the competitiveness of US exports and mitigate the trade deficit. The impact on Japan was twofold. First, the yen appreciated significantly, making Japanese exports more expensive and less competitive in international markets. This, in turn, had negative effects on Japan's export-dependent economy, which had been a key driver of its rapid economic growth. Second, the Plaza Accord contributed to Japan's asset price bubble. As the yen strengthened, it made imports cheaper for Japan, leading to an influx of capital. This capital, combined with already loose monetary policies in Japan, fueled a speculative boom in asset prices, particularly in real estate and stocks. As asset values escalated, so did speculation, especially in real estate, often funded by corporate stock profits. Banks were liberal with lending, overlooking potential risks. In an effort to curb inflationary pressures and deflate the bubble, the Bank of Japan initiated a series of substantial interest rate hikes from 2.5% to 4.25% at the end of 1989 and further to 6% in 1990. However, the spike in interest rates led speculators to default on their investments as borrowing became more costly. This marked the bursting of the economic bubble. Japan's stock market plummeted and asset prices crumbled. Several major banks, burdened with speculative investments, either collapsed or required government bailouts. Businesses folded and unemployment surged, trapping Japan in a decade-long recession. The country found itself in a liquidity trap where conventional measures by the central bank seemed ineffective. Despite interest rate cuts, citizens, apprehensive about the future, held onto their savings instead of spending. Although the government attempted large-scale public works projects, it only exacerbated Japan's budget deficit. Ultimately, the central bank resorted to injecting significant amounts of yen into the markets through a 5-year period of quantitative easing. Coupled with resulting inflation, this strategy prompted Japanese citizens to resume spending, marking the beginning of a gradual economic recovery. Will China enter deep recession and become the next Japan? In the 1960s, the anticipation was that Japan would surpass the United States. However, this prospect didn't materialize due to Japan's immersion in a colossal debt-fueled asset bubble. More recently, the focus shifted to China, as the contender poised to overtake the US, a seemingly surer bet. Ironically, China appears to have embarked on a path akin to Japan's, encountering hurdles such as hypergrowth fueled by debt and substantial asset bubbles, primarily in the property sector. China is currently grappling with its most formidable economic challenge since embarking on liberalization over 4 decades ago. Growth has sharply decelerated, the property bubble has burst, and numerous property firms are either on the verge of or have defaulted. The property sector, constituting a quarter of its gross domestic product, is in its 3rd year of turmoil, with no signs of improvement. Coupled with a rapidly aging population, the situation bears a striking resemblance to Japan in the early 1990s. While parallels exist between the current challenges facing the Chinese economy and Japan's economic woes in the 1990s, such as slowing economic growth, a sluggish real estate market, and an increasingly aging population, there are noticeable differences. Many economists contend that the risk of China plunging into a deep recession remains small and manageable. Supported by economic resilience, sound policies, a robust central government, and a vast market, China is not poised to replicate Japan's trajectory. One key distinction is the over-reliance on real estate in Japan, a trend that persists to this day. In contrast, China has capitalized on opportunities in new energy and the internet, excelling in areas like the digital economy and new energy vehicles. Additionally, China's exports are unlikely to plummet as Japan's did. With a global export share exceeding 14%, China outpaces other economies. The depreciation of the yuan and a slowdown in disposable income growth are expected to bolster China's export competitiveness. Furthermore, China's economy operates under a national strategy and long-term plans for manufacturing development, backed by a substantial domestic market, enhancing its stability and resilience. Unlike Japan when its bubble burst, China still possesses significant catch-up potential, where growth is more achievable than at the technological frontier. There remains considerable room for growth and economic catch-up in China, especially if policies prioritize the domestic reallocation of labor into more productive employment. While demographic policies aimed at boosting the birth rate may not yield immediate results, China's retirement age of 55 provides an opportunity to integrate experienced older workers into the workforce amid rapid population aging. Despite the challenges of supporting an aging population, the productivity of the Chinese labor force benefits from the higher education levels of younger workers compared to previous generations. China is not Japan. Similar to Japan decades ago, the current state of the Chinese economy is marked by real estate and stock market bubbles, escalating debt, heightened risks of default, and persistent lending to zombie companies. Despite the parallels, crucial distinctions exist between Japan in the 1980s and contemporary China, encompassing economic fundamentals, developmental stages, macroeconomic policies, and notably the responsive governance under China's central government. China is undeniably undergoing a substantial rebalancing. Presently, the nation confronts three primary challenges: debt, demography, and diplomacy. While addressing demographic concerns may pose limitations in the short term, China has the potential to ease tensions with the West, adopt more pro-business measures, and earnestly tackle its debt issues. We do not believe China will become the next Japan and lose its economic edge. Do you agree with us? Share your thoughts by leaving comments below. If you found this video informative, express your support by hitting the like button. Most importantly, subscribe to this channel to stay updated on compelling videos covering developments across Asia.